have you got your old background? And welcome to our 2025 half-year results. I'm going to share our slide now, but I just wanted to welcome everybody to our presentation. So today I'd like to just go through our reporting segment, the operations review. I'll hand over to Clifford for that, and then Clifford will, once he's been through the financial review, come back to me, and then we'll go through the outlook. So let's go straight then into the H1 results. So tough trading. Tough 6 months for us at least. The positive momentum we had, I think if you guys remember when we results in January, we had a really nice end to the year, and we had hoped that that would continue into the first half of this year. December and January, however, were not as good as we had hoped, but we thought that they would pick up. But there was definitely a slowdown from the end of last year. South Africa, as we all know, has been now recorded as one of the most or worst difficult, all the different, it's just a difficult place to do business in this. And we're really feeling it. It's really tough to do business in South Africa. It's been really, there's been a lot of low business confidence. When I did the results presentation, I had no idea. You know, you are fighting instead of working together for the best interests of South Africa. We've had our friend Donald and his tariff wars creating uncertainty around the world. And then, of course, we've had the war in the Ukraine and all the nonsense going on in the Middle East. So, you know, these are things that have just brought business confidence down. A really big thing for us, as all of you know that have followed us for many years, mining and manufacturing are a very big part of our business. And if we look at what's been happening over the last few years, and especially the 6 months, the big thing of this year have been mining and manufacturing. And if we go back to the 1980s, you know, mining was 21% of South Africa's GDP. We were one of the top mining countries in the world. Wow, look where we are now. It's now only 6 or 7%, you know, of our GDP. So, you know, we've had a decline of, I think it's around 4.1% in mining and 2% in manufacturing. And although these have gone backwards and the economy's gone backwards, I'm happy to say that we've managed to keep the percentage of our turnover still up there. So we've managed to do some good in a declining market. We concluded the Isotech and FlowSolve acquisitions. Isotech only in for 1 month, but they'll be in for the full 6 months, and so will FlowSolve. So we're very excited about their contribution in the second half. And I think a very important thing is that we generated 442 million of cash from our operations in the first half. That's an important sign of a healthy business. So let's go and talk to the numbers. Let's start off with our turnover. A little bit disappointing for us, I must say, to be down 2.4% to 3.9 billion. Our gross profit margin up. This is a really good result. Those that have followed us for the last couple of years, we've managed to just inch those up a little bit. So it's managing the things within our control. Not that easy, but up 0.8 percentage points to 37.8. Operating profit up 1.5% to 419 million. Our comparable earnings per share up 6.1% to R8.33. And Clifford will take you through the differences now in our headline and comparable and basic earnings. And that's really around the vendor liabilities. That's a wonderful story for the accountants to talk about. And their headline earnings are 90.6%. Up at R9.38, and our basic earnings are up 19.9% to R9.41. Our interim dividend is up 7.7% to R3.50. So just briefly, let's just go through our business model. We go through this in a lot more depth at the beginning of the year, but just generally for those maybe that are listening for the first time, our main business is the importation and distribution of high quality branded automotive, industrial and electronic consumable products. Our value-added concept, our value-added distribution is key to our business model. Our agency agreements generally restrict us to Africa south of the equator. We have a diversified portfolio of businesses which limits our risks and makes us resilient. We have many businesses in many sectors, and that's what we've tried to achieve over the last kind of 15 years. We've kind of really diversify our business range into different sectors. And the advantage, even in those different sectors, we have many different products in different industries. We have a completely decentralized, focused management philosophy at Hudaco, and it's in our teams. So we have industry-specific specialists in all of our businesses, and that leads to quick decision-making. The control and accountability is at the coalface, and that can happen. They don't have to wait a long time to make these decisions. So we always like to talk about our value-added distribution and what does that mean? For us, it's the focused business units having the application advice and knowledge. It's the technical specifications that they are able to give to our customers. We get that training from our suppliers. We then pass it on to our customers. It's the credit provision that we give to our customers, and that generally drives customer loyalty. We are a level 3 BE company, which we're very proud of. And even with adding our 2 new acquisitions, we have managed to stay at the level 3. So we're very happy with that. Our inventories at half year are sitting at around 2.8 billion rand. We like to think that we've got instant availability around the country, at having all the right products in the right places at the right time. It doesn't always work out that way, but it's what we strive to achieve. We have 31 warehouses around the country, 800 international suppliers, and over 230,000 line items, and 130 branches spread throughout the country. On our receivable side, we're sitting at about 1.3 billion rand there. We have 30,000 active customers at any one time. This is, I think, a really healthy thing for us, is that what it means is we've got generally low value transactions, and because we're selling bearing sprockets, chains, small values, we're not really big tender and contract business company where we have big risk on big numbers. So let's talk to the reporting segments. Just in the top right-hand corner here, you'll see where we were for this time last year. Consumer-related products giving us 43% of our operating profit, and engineering consumables 57%, down slightly to 55% this year and 45% for consumer-related, but really not much change there. So to talk to the consumer-related segment, these are the businesses we have in this sector. They really import and distribute branded products driven by consumer spending and generally sold to installers. So we have 12 businesses here, and we really supply products to the automotive aftermarket, to power tools and fasteners, our data networking equipment businesses. We have our batteries and alternative energy product businesses, security and communication, our gas and outdoor products, which is predominantly KDAC. So let's look to those numbers. A bit disappointing, turnover down 6%, and I think that's a lot to do with where the economy is, to 1.8, operating margin at 11.3%, and operating profit up 7% to 200 million. So managing to control the things within our control, our gross profit margin and expenses, giving us a increased operating profit. KDAC, our automotive and data communications, had a much improved performance, I'm happy to say. Unfortunately, our security business, our battery, fastener and power tool businesses really struggled in this economy. So most businesses throughout in the weak economy, we've had reduced volumes, other than our KDAC automotive and data communications businesses. We now look to our engineering consumables segments, and they distribute branded products We like to think that in all of our businesses that we carry at least one of the top 3 brands. We also have the second tier brands that for most of the products that we sell. And these are used for repairing and maintaining machinery. So we have around 20 businesses in this portfolio. We supply bearings, belting, and power transmission products, diesel engines and spares. We have electrical power transmission products, and now Isotech will come into this sector. We have our filtration and fluid transfer, which FlowSolve will now fall into here. We have our fire detection, containment, and suppression, and that's really our Bridget acquisition from a couple of years back. And Clifford will talk to that in his numbers. Our hydraulic and pneumatics business, our specialized steel businesses, and then, of course, our thermoplastic pipes and fittings business. So just talk briefly to our acquisitions. Isotech, not much to say, and the numbers don't really mean much in these results because it's just 1 month. We'll see a better impact at half year, and then obviously the full impact in next year. But the effective date there is 1st of May 2025. They're a manufacturer and distributor of thermal and electrical insulation materials, and those are used in the manufacture and repair of transformers and electric motors. So it's like you see in the top right-hand corner, you've got an electric motor. It's those insulation papers and wires that go into it. And there you see the machinery we have. Operating in the manufacturing, mining, railway, generation, and switchgear industries. And just a reminder, the initial payment we made here was 250 million rand. Our acquisitions talk to FlowSolve as well. That will now be in us for the full 6 months, effective date 1st of June. They import and distribute specialized equipment for handling of fuels, lubricants, greases, and other fluids associated with the servicing and refueling of plant and machinery, especially in the mining industry. Initial payment here is 45 million rand. So let's talk to the engineering consumables numbers then. Overall, we are slightly up due to the acquisition at 0.6% to 2.1 billion, so pretty flat there. Our operating margin at 11.5%, and our operating profit also kind of flat at 244. I think a reminder here is that for our engineering consumables business at half year, this is a very good operating margin. And that's really because we have the December, January holiday periods and also the Easter holiday periods where we're sitting with this big expense base and lots of branches throughout the country with kind of low turnovers. So this 11.5 is a very good number in the first half. Our diesel engines, electrical power transmission, our thermoplastic pipes and fittings business has really performed well, and in fact exceptionally well in this first half, so we're very pleased with that. The majority of these businesses had a pleasing first half despite the declining mining and manufacturing sector. So I think that's an important thing. You know, we talk about what I said, that our mining and manufacturing sectors were the biggest drain on the economy, and we've managed to kind of, in our whole business, this makes up 30% of our business. In the engineering consumables, it's as much as 50% of the business on the engineering consumable side is mining and manufacturing. So to be able to maintain in a declining sector, I think is a good result. The pulley, bearings, filter, gear pumps businesses, unfortunately, we're quite disappointed with the result that they had, but we're looking forward to a better result from them in the second half. So let's combine those segments. We're looking at 3.9 billion, just down 2.4% on our turnover. Our operating margin slightly up from last year, 10.4 to 10.8. Again, for the first half, quite a good result. And you'll see from the slides coming up that we have a much better second half than our first half because of what I explained earlier on. Our operating profit up 1.5% to 419 million. So let's just go through those. Here we see the gross profit margin increasing slightly from 37% to 37.8%. The operating expenses, so this is the expense to sales ratio. We're obviously disappointed with this number increasing from 26.6 to 27%, but the actual rand value year on year, even with the acquisition in, is lower than it was last year. So it kind of points to our problem is that the sales, the turnover number, and that's our focus area. So it's more about the sales line than the expense line. Here we see the differences in first half and second half performance, and just to try and illustrate the difference in the second half performance, we now have a really good run. We don't have the holiday months and everything, and we can get on with business. So we're looking forward to a really much improved second half and a good full year performance. I'm now going to hand over to Clifford. Clifford will take you through the financial review, and then he'll come back to me on the outlook.
Thanks, Graham, and good morning, everybody. I'll pick up on some of the numbers you've already seen and then develop them from there. So our turnover, what we've done through all of these numbers is we've tried to show you our figures on a like-for-like basis. So we've pulled out the acquisitions and shown a line called operations that have been in the group for 18 plus months. In other words, from the beginning of the 2024 financial year. So a full year last year and the full first half this year. So that is a like-for-like comparison. And our turnover is 3.4% down at 3.847 against 3.983 on a like-for-like basis. And the acquisitions have reduced that decline to 2.4% and total turnover 3.886. Our gross profit is 1,470 million, and that is just 4 million down, so almost the same as it was in the first half of 2024. Operating expenses on a like-for-like basis, 1,045, so 1.5% down on the 1,060. So we've actually reduced our operating expenses on a like-for-like basis, just about 1.5%. With the addition of Isotech, it's a 1% overall reduction in the rand value of operating expenses. The operating profit on a like-for-like basis, 414 million rand like-for-like, same as in 2024. Those are rounded numbers, so actually there's almost a 0.5% increase in the operating profit, but you don't see it because of the rounding. Acquisitions add a little bit more, and we're at 419 million, 1.5% up on last year's first half. So from the operating profit through the rest of the income statement, and starting at that 419, the first thing, as Graham promised, is the fair value adjustment to the vendor liability on the Bridget Fire acquisition. Now, Bridget Fire has been in the group for coming on 2 years, just short of 2 years, and it has performed superbly well. We have, if you take the average profit over our estimate to the end of the first of those 2 years, it is 30% higher than the profit was when we bought, or just before we bought, Bridget Fire. So coming into the group as was, and then we've grown that profit by 30%. However, accounting requirements are that every reporting date, we make a best estimate of how much we think we're going to have to pay on that earnout. And we present value that and record it as the vendor liability. When we last did this at November, notwithstanding the good performance of Bridget, we were even more optimistic, and we thought that the vendor liability would be higher than we currently think it will be, because these are all estimates. And so we have reduced the vendor liability by 35 million rand, and that then reflects as an income item in the income statement. And that is the primary difference, as you will see later, between our comparable earnings per share and the other earnings per share measures. Then we have the fair value adjustment for time value of money. That simply is imputed interest on the vendor liability, same as the first half of last year. Our net interest on funding, that's our good old traditional real interest, is 43 million rand against 64 million rand in the first half of 2024. That's because our borrowings have come down and interest rates have come down. Our borrowings with the acquisition of Isotech and just after year end, also FlowSolve, have gone up a bit since most of this half year. And therefore that number will climb a bit, but fortunately the rates are still good. Then imputed interest on leases, that's IFRS 16, and the number's almost the same as it was in the first half of 2024 at 17 million. So our profit before tax, 387 million, reflecting at 19.2% up on last year. The tax, if you just calculate the tax rate, it comes out at 24.7% against the standard rate of 27%. The reason for that is the vendor liability fair value adjustment is not, it has no tax consequences. So if you take that out, our tax rate is actually 27.1% against the standard 27, and you can see it was 27 in 2024. So apart from the vendor liability adjustment, there's really nothing in it. Profit after tax, 292 million, 22.9% up. The non-controlling interest is 25 million to the minority shareholders against 15. Part of the increase comes out of that fair value adjustment. So we have attributable earnings 19.9% up at 267 million. Carrying those attributable earnings through to the other two measures, well, headline earnings is almost the same at 266. It's just a small profit on disposal of PPE that adjusts it. Then you can see we've taken out that gain on the fair value adjustment on the vendor liability of 35 million. And associated with that is the minority share, which is 5 million. So comparable earnings, 236 million, 6.1% up on 223. Looking at the comparable earnings over a period of time by half year, you can see quite clearly that the grey blocks are much, much taller, and that's because our second half of the year is much stronger when it comes to earnings than the first half. So in the first half, we have to deal with December, January, and April, all holiday months. The second half of the year, we have full trading months for all 6 months. And on top of that, our busiest period tends to be those last couple of months of the year in any event, which gives it an additional boost. And there's no reason why this year should look any different from that. And the first half, you can see that we're slightly up there at 236 million. Earnings per share, well, there's been no change in the number of shares, so these figures flow straight through. The percentage increases are exactly the same as the increases in the rand values. Comparable earnings per share, 833 cents, and headline 938, basic 941. Dividends, 3.50 rand per share against 3.25 last year, so that's up 7.7%. We're confident in our cash flow, and that number made sense in a number of respects. It is, as a half-year stage, we're 2.38 times covered on that dividend of earnings against 242, which is really just rounding. And our policy for the group for the full year is to be about twice covered, so around about 2 times. And traditionally, we pay a little bit less at the end of the first half, and we do the catch-up at the end of the second half in the final dividend. So we always expect the cover to be higher than the 2 at mid-year. The statement of financial position, so it's a working capital business. We've got almost 2.9 billion rands worth of working capital, only a very small increase since 2024. The main item there is the inventories, and it looks like it's gone up, but in fact, that's because of the Isotech acquisition. If we back out the Isotech at acquisition value from the current inventories, then they've actually gone down by a very small number. I think it's 9 million rand that they've gone down. So nicely maintained, the inventory levels there compared to last year. Receivables, even with the acquisition, are almost the same. So effectively, they've come down. And similarly with payables, they're very similar. And traditionally within Hudaco, the receivables and the payables are fairly equal, not a big gap between them. So really our working capital is all about our inventory. Property, plant and equipment up partly because of the acquisition at 402 million, but it's still not a big number in the context of the group. The right of use assets at 359, that's IFRS 16. The asset side of the right to use the premises that we rent hasn't changed very much. Our goodwill and intangibles, well, the goodwill, or both of those categories, in fact, goodwill and intangibles have gone up on the Isotech acquisition. That is the main reason for the change. And we have a small number tax asset, not worth talking about. Our equity up from 3.4 billion a year ago to 3.655 now. And our net borrowings at 957 million are down from where our borrowings were at the end of May in 2024, notwithstanding the fact that we paid 250 million on the Isotech acquisition as the initial payment. So the borrowings position is actually looking pretty good. Our lease liabilities, it's the other side of IFRS 19. We owe vendors, and this is our estimate of what we owe vendors over the next 3 years for the last bit of Bridget as well as Isotech, 363 million rand. And then again, a number for tax, but not a big one. The working capital elements, so quite a complex slide here. We've broken it down. The black line is the overall working capital, and that is sitting at 4.2 months. The stock is the dark blue block at 4, and I'll show you in more detail shortly. Next slide. The grey, the debtors, and the light blue, the creditors, that, as I've said, more or less equal each other out. We have taken out the Isotech acquisition from the working capital because it was only 1 month before half year end, and so it had very little in by way of sales, but all the assets and liabilities. So we did make that adjustment so that we had a sensible comparison. And looking at that inventory in more detail, again, we've split it by half year. So you'll see it's currently at 4 months sales in inventory against 3.9 a year ago. And typically we stock up at the end of the first period because we have our busy 6 months ahead of us. And then the stock reduces over those 6 months. So the year-end number is usually a lower number of months in sales. The cash flow, our cash from trading, 534 million rand, almost the same as 2024. We've increased our working capital a little bit there, 92 million rand. So we have cash from operations of 442 million. We paid tax, so this is the cash tax paid of 143, leaving us 299 million of cash from operating activities. We invested 252 million rand in our new businesses and earn-out payments. Invested in software and PPE, 37 million rand, and traditionally our investment of those kinds of items more or less equates to depreciation plus a little bit for inflation, 37 million, and we've got cash after investing activities of 10 million rand. The other cash flow items, they're share-based payments, which are about half of what they were in 2024. Our lease payments, this is our real rent. This is what our lease agreements say we have to pay, 78 million rand against 76. And our finance costs, 43 million. Again, that's the normal old-fashioned finance costs, nothing imputed because this is the cash flow statement. We paid dividends of 224 million rand, leaving us net movement of 370 million. We started this year with borrowings of 589, so we've now got 957, whereas in 2024 we started the year with 59 million. We started with 1,013,000,000, and we closed the first 6 months at 1,076,000,000. So we are certainly down from where we were a year ago, notwithstanding the payment for Isotech. Just to wrap up my section with some key financial points, our stock levels, as usual, are higher at the end of this first half for the busier second half. The operating margin is up, as Graham showed you, and it's healthy in most of our businesses. The H2 operating margins are almost always, if not always, higher than the first half of the year because of the busy months. Our expenses, you could see, they are tightly managed and in fact are lower than they were last year. So any further decrease in interest rates should be a boost, will be a boost for us, although just the caveat that we have paid for some acquisitions and another one to pay for, so that has added to our borrowings, but nonetheless our interest bill should be very, very comfortable indeed. Our businesses are cash generative, even in a tough economy. And the borrowings are well within our capacity and within our covenants. And just by, for context, with the current EBITDA, in terms of our covenants, we would be allowed to have double the current debt than we do have at the moment. And if we make acquisitions and increase our debt, we also increase our EBITDA. So that's extremely comfortable. And similarly, our other covenant on times interest covered, we could bear an interest bill of 3 times what our current bill is and still be within our covenants. Then on our capital allocation strategy, that remains unchanged. We will pay our vendor liabilities over their earn-out periods, which is three years as we stand. We will maintain our dividend policy. We have every intention of doing that. We're looking for further good acquisitions. We will, if we don't find enough acquisitions to use up the cash, we'll repay debt. And we remain opportunistic on share repurchases. We are very happy to consider well-priced, decent-sized parcels if they're out there and available. But we are not hung up on making share repurchases at all. We will be opportunistic on that. And as I said, that closes it out for me, and I'll hand this back to Graham to look at the outlook.
All right, thank you, Cliff. So to the outlook, let me do the best I can here. So I think some important things to talk to is that Hudaco has remained resilient, even though achieving organic growth from our existing mature businesses in declining market sectors is very difficult. So if you look at a lot of our businesses in the engineering consumable side, we've had these businesses for a long time. Their mining and manufacturing, as I said earlier on in the presentation, has been going backwards, and it's a third of the size of the GDP. Can you imagine how well South Africa could be if our mining and manufacturing was still at the same level as our GDP as it was 40 years ago? Anyway, we continue. It's difficult for us to get growth, but then what do we do? It's been our strategy for a long time now, is that we've tried to diversify our portfolio, but our businesses are cash generative, and we try within those businesses to manage it within control, the things that are within our control. So if we look at gross margin, expense ratios, our working capital, we do that very well. And you've seen from these results as well as that, even though our turnovers are down, with the gross profit margin and expenses, we've managed to squeeze something here and there. So by managing the businesses that we have, we produce cash, and we produce good cash. And that cash allows us to pay attractive dividends. We've always been a good dividend payer, and we make accretive acquisitions. We've really been very fortunate with the acquisitions that we've made over a long period of time, and this enables us to achieve the earnings growth that we need in the South African environment. The potential for Hudaco is enormous. I've always said that. I mean, I love Hudaco, and as a South African Inc. company, it really depends on our country's political leadership, and they really need to get their shit together. And, we need to create a conducive environment for business growth. And, if they can do that, Hudaco is so well placed to take advantage of any uptick in this activity. So, we're looking forward to the contribution from some of our underperforming businesses in H2. We had a few of our businesses that didn't perform as well as we would have liked in the first half. We're obviously managing those and trying to get on top of that. And we're convinced that we will have a better performance in the second half from them. Our profits from Isotech and FlowSolve will be included in the full H2 results. So that's a very good point there. Our Hudaco businesses traditionally have a much better H2. I think that goes without. You've seen the the graphs that Clifford has shown you. So we're looking forward to that growth going forward. And our management team is looking forward to the full year results. So from a team, we've looked at our budgets, we've looked at the changes we've had to put in these businesses that have been underperforming, and we're looking forward to a very good year-end result. So I think that's really all from our presentation. I'd like to thank you all for listening to us. We've got a bit of a question and answer session coming up, so we're going to try and answer those questions for you. So I'm going to finish this, stop sharing this presentation. I'm going to zip over here so Clifford can join me. And right, where are the questions?
Okay, so I have got them here in front of me on a screen, but it'll work. Let me start with the first one from Charles. Could you give us more detailed insights as to what differentiates Isotech? Do they have product agencies, accreditations with customers, installed bases, etc.? If not apparent, what basis for the goodwill paid?
So, if we look to Isotech, they don't have any specific product like we have in most of our other businesses where we have a brand. They have their own brand. I think they're one of the two biggest suppliers of the products that they provide in the country. They offer a very good service. They have a very good range of products, and the profits they make from their turnover really leads to the goodwill that's there. So, I don't have any specific product line or anything there that I can talk to.
Okay, then you adjust the fair value adjustment of 35 million in calculating comparable earnings. Why do you not adjust for the 7 time value of money in the comp? Charles, that's the time value of money is, the accounting requires that we account for present value and then impute interest on it, and that effectively means you're seeing it as a borrowing. So you're seeing the vendor liability as an interest-bearing borrowing for accounting purposes, and that's an every year thing. So long as we've got the earnings from new acquisitions coming in, we have to deal with that until we finish paying that price. So and it's invariably a relatively small number. So we don't see any merit in pulling that out of comparable earnings every year, given that it's sort of embedded in the operations in that way. Whereas here, it's a case of saying we estimated the liability at a particular number, and we've now had to reassess that, and we've dropped that level of the liability. Now that distorts the results if we just leave that in. So we pull it out for comparable earnings, whereas the imputed interest doesn't really distort the results. Could you explain the difference between basic earnings per share and comparable earnings per share in this case, and why there's such a difference? So I think that's been covered. There's a swing to Chinese autos in South Africa. How's your aftermarket auto segment positioned to handle this? And
yeah, so Bruce. I think that, Bruce, to try and answer that, is that the aftermarket segment traditionally up until now normally follows 5 years after the original sale, because the OEM give a warranty normally around a 5-year service plan and warranty period. So they take their cars back to the OEM. So it's really once that pool and those warranties are out and the service agreements are out that people will then use other products and our products. So we don't see that in our turnovers right now, but in the years going forward, that will grow.
Okay. Quibus has asked, has there been any change in lead times with the current suppliers given the tariff concerns in the USA? Has that come down as more product is reprioritized for geographics other than the USA? And how has that changed? Sorry, I've just got an obstacle in my way here on the screen that I can't get rid of.
Yeah, so that for most of our businesses, our lead times have improved from the difficulties that we had kind of last year. So we're finding a little from the supplier point of view, it's really been fixed for a couple of years now. Our problems were really the South African port side and not our supplier side. We're definitely finding that things are a little bit more freely available from the East because of the problems with the tariff wars in America. But it's not something that's affected our lead times at all. It's just there's more available for what we need.
Okay. Nati has asked, can you talk to Isotech's expected performance and seasonality, if any, particularly as it pertains to H2, and would H1 reported contribution be the normalized run rate?
Please don't worry about, we debated whether just taking that 1 month out, it's not a number, it's a no number thing. It's the first month within in Hudaco. I don't think you need to read anything into that. You cannot use that as a run rate going forward. It's, if you look at, I think the basic idea with Isotech, and it goes back, maybe back to a little bit to that goodwill question as well, is that the difference is really what we expect to pay for the business and what the net asset values of the assets are at the end of the day. So if you look at, we paid 250 million for that business. You can work out yourself. We normally pay a 5 times multiple for that business, and we're hoping to pay over 700 million. So we're hoping to grow that business a lot. Cannot take 1 month, first month integrated into Hudaco as something to work on.
Yeah. Okay, how is the aging and provisioning of your debtors book looking? Better, worse, or same as usual? It's pretty much the same as usual. Our debtors book is normally in pretty good shape. A lot of our debtors are blue chip, and we don't have massive exposure to single debtors generally.
Yeah, and I think it's talking to those slides I said earlier, they're generally lower value transactions. So, we obviously do have some small debts that we have to write off when people misbehave, but there's normally very well managed within the group.
I think our biggest, it fluctuates just depending on transactions, but from time to time we'll find our biggest debtor sits at maybe 3% of our book. And those are short-term debts. Can you talk, we've dealt with that one. Your shares seem very cheap. Yeah, we think so too, Catherine. Why not be more aggressive with share buybacks?
Give that girl a bells. Yeah, so I think we like to look at getting a parcel. To just go out there and buy 1s and 2s and 10s and 100s doesn't help us at all. So a nice sized parcel would have to come up for us to buy. But our real priority is acquisitions, and we've made some nice acquisitions now. They are a lot more accretive if you look at what we pay as a multiple compared to where our share price is. So we always look at the difference between that.
Yeah. Then I think that's probably worth mentioning that over the last couple of years, we've bought back about 11% of our shares. So none in the last year to year and a half, but prior to that, in the 2 or 2.5 years before that, we bought back, I think it was 11%. Talia, I'm just looking at your question here about how we account for the acquisitions. Not quite sure which angle you're getting at. So my suggestion is rather than try and do that, detain everybody on it, why don't you just give me a call and then we can sort that out, and I'll explain what it is you want to know. Sean, the ABSA manufacturing PMI recorded a notable improvement in June relative to the first 5 months of the year. Have you noticed a similar recovery in engineering consumables business? That says, yeah, following the interim period.
Yeah, so I think May and June, not just June for us, May and June were better than last year's May and June. So we think we kind of agree with that, and hopefully this carries on.
And then what's the major driver behind the muted growth in expenses? Staff performance related payments reduced, David's asked.
So there is David, definitely, yes, there is a certain amount. So what we do look at half year, those underperforming businesses, we provide throughout the year for bonuses, and if you have a look at our expenses, it's really our salary bill is one of our biggest things, and our salaries really we pay like a really we think a competitive salary, but we have good incentives. So when people are behind at half year, we have a look at exactly where they are, and then we kind of write back whatever provision we had in line with how they've performed. And obviously, if they do better in the second half, it'll self-fund, and we'll increase that provision towards the end of the year. But it's really controlling the expenses that we have. We've closed down some. If we have a look at our Bosworth business that we've spoken to, we've said that we were shutting down our idler and our fabrication business. We've sold the idler business. It's not money, but we've got rid of that expense. All the people that are involved there, that's kind of out of it. So it's really more to managing the expenses really in those businesses that are not performing as well as they should.
Okay, then Catherine's question on it looking like inventory levels in month sales have been ticking up for a number of years. Is this still a strategic decision? So yes, it was a strategic decision with all the problems that we had in logistics, getting shipping through and then getting everything through the ports and up to us. So we did increase it. We've certainly seen an improvement in the logistics, and that ultimately will come down a little bit. But it's also been affected by the fact that the sales in this first half have come down. So we stocked up for higher sales in the first half. They didn't come through, so some of that stock is still with us, but it's good stock and will be sold in the second. And that counterbalances the reduction that some of that reduction that we've been able to achieve through improvement in logistics, and that's why we're pretty much at the same level as we were a year ago. Are we currently, David, overstocked for current poor trading conditions?
Yeah, David, I won't say to any scary points. So if we look at our actual stock, we take the acquisition out. Our actual stock value is slightly lower than it was this time last year. So if you take that metric into, I think it's better. There's absolutely no doubt that in the underperforming businesses, the businesses that budgeted to do better in the first half, we brought that stock in for them and they didn't have the sales that they had hoped to get. Those businesses are overstocked for sure.
Okay, then Talia's asked about goodwill making up about 20% of total assets. What would you say are the main risks that could trigger an impairment, and how do you test for this across the various businesses? Let me answer the second half first. So we do rigorous expectation and present value, all of those, and we have them audited and with expert input into them. So that's how we test across the various businesses. We did in 2024 have a 77 million rand impairment at Eternity, and you're asking what triggers this sort of thing. Well, it's where a business is really performing badly and our cash flow projections, when I say badly, I mean a lot worse than at acquisition levels, and having finished paying the vendor liability and having calculated the final purchase price and got a figure to what our cash flow projections say that the value of the business is. And generally that happens when there's a poor performance that looks like it's a sustained poor performance, that there's been some sort of fundamental shift in the field in which that business is operating, and that we're not going to reverse a bit of a dip because the market has changed. And we saw that with Eternity last year, and Eternity is still far from where it should be, and we haven't finished turning that around. So we were right to impair that goodwill. It's the normal thought process. There's nothing special in the way that we tackle that goodwill element. The difference between, okay, that one we've done. Any green shoots in the platinum mining sector yet, given recent significant basket pricing increases?
David, yeah, thanks. I don't think we're seeing that yet. We're hoping to see that flow through now in the second half of the year. So I think in these first 6 months, we haven't seen anything come through. But when things do start getting better in any of these mining industries, it obviously flows through to us. And platinum is our biggest sector in the mining that we look after. So we're hoping for a good contribution in the second half.
Are we experiencing any increased competition in any of the areas in which we operate? Are there structural challenges in any market? Are all the businesses in a healthy state to grow if the economy picks up?
Yeah, so we've always got competition, and I think in just about all of our businesses we've got good competition. They're big companies and they do a good job, so that hasn't changed at all. Any structural changes in the markets? No, I wouldn't say that. Just that it's been very difficult. Are all our businesses in a healthy state? I won't say all of our businesses are in a healthy state. We always have a few, maybe 5 or 6 that need extra care, more care than others, and more involvement from senior management to try and turn it around. But I would say that all of the businesses are in a position to take advantage of any pickup in the economy. They are all, if you look at our expense ratio, if you look at the stock we're holding, we're ready for anything, and that just really falls. We've seen it sometimes over the years, those that have followed us, it just falls straight to the bottom line. So we're just ready for it.
Then are there any specific challenges or once-off issues that occurred in the businesses that struggled? What's being done to fix any issues and improve performance?
Yeah, so the end to my slides were that we were hoping for a better performance. Well, we're looking forward to a better performance from the underperforming businesses. So we've had to change some management structure there, and we've had to change some MDs in some of the businesses, unfortunately. But we've got some new MDs in place for those businesses. Some of them have been in for a couple of months now, but it takes a couple of months for them to get traction. And we've also got some starting. So we should see the benefit of that coming through in the second half. So it's really about management. It's people. And I think that's it.
That's actually on this other screen here. Looks like we've covered the questions that have come through. No, hold on. Here's some more. Great work on the cost control. How much of this would rebound with an improvement in volumes and activity levels? For example, expenses such as sales incentives.
That's self-funding. So the expenses, it's not just the incentives, it's also the delivery costs as well. So it's self-funding. It will go up. If our turnover goes up, we deliver more. People make better incentives. It will go up.
Can you speak to the trends you've observed in the early weeks of H2 across both segments? You did to some extent already answering another question. Are you seeing more activity on private businesses for sale? And how are the valuations expectations for these versus the past few years?
Yeah, so we haven't changed our valuations. For what we're looking for, we try and pay around that 5 times multiple, depending on the type of business, size of business, what market they're in. So we haven't seen that from our side, and you've seen the 2 acquisitions we've made have been around that 5 times multiple. And I think that's it.
That does seem to be the end of the questions. So thank you.
Yeah. So thank you, everybody. Thank you for listening to us. Thank you for joining us. I look forward to this next 6 months. I look forward to seeing you all in January and hopefully talking to a good story. Hopefully our government can make some right decisions on the policies and put some decent policies in place that will help grow our economy and our businesses and help employ people, and that we can be part of that. So thank you, everybody. Goodbye.
Cheers, everyone.